Welcome to Make a Difference with RJ channel. CME Part 2. In this video, we are going to learn how to forecast different types of assets return, fixed income, equity, real estate, and also try to forecast exchange rates. And the last one, forecasting volatility. Forecasting fixed income returns. We have two approaches for this. One is discounted cash flow approach and the second is risk premium or building block approach. Now the discounted cash flow approach is discussed in depth in the fixed income itself. So there are not much calculation. There are only few points we need to remember in the discounted cash flow approach. There are few terms you should be already familiar with, such as YTM, mod duration, and Macaulay duration. We have learned how to do the calculation of all these three in a level 2. But let's just look at the Macaulay duration. Macaulay duration is equal to mod duration multiplied by YTM, and it is a very important term that tells us whether the investor will get the return equal to YTM or not. There are three scenarios here. When the investment horizon is equal to Macaulay duration, then the investor will earn YTM return. And if the investment horizon is longer than Macaulay duration, then there is a reinvestment risk which dominates. Which means if their interest rate is falling, then it will give lower return than YTM. Why is that? Because the coupon will be reinvested at the lower rate. And the third term, if the investment horizon is shorter than Macaulay duration, then capital gain or loss will dominate. So falling interest rate will give higher return than YTM. Why? Because if the interest rate is falling, then the price of the bond will increase and that will capital gain will happen. So these are the three terms you need to remember. Then next thing we will do later on, the DCF analysis in fixed income. The second approach for the fixed income return forecasting is risk premium approach, also known as a building block approach, because it starts with the risk-free rate and then we add different risk premiums to it: term premium, credit premium, liquidity premium. And we need to forecast these premiums and what are the things which which affects these premium. For example, for the term premium, inflation uncertainty, recession hedge, supply and demand, business cycle, all these things affect term premium. So if there is a recession, term premium will increase. If there is a demand more than supply, then term premium will increase. If the business cycle is in slow down mode or contraction mode, then term premium will increase. Exactly the same way, credit premium. In the credit premium, we have the high and low grade. So the bond which are low grade, then credit premium will increase. If the bonds are from the corporate, not government bond, then credit premium will increase. Exactly the same way, liquidity premium. So the new issues and large size, known issuer, all these things affect liquidity premium. If there are, if the size of this bond offered is large, then liquidity premium will decrease. If the issuer is known and the issue is new, then again liquidity premium will decrease. So we need to keep all these points, and then whenever the question is there, we just and add all these premiums and we have the forecast ready for the fixed income. Emerging market offers higher return. So does it has a higher risk. So we need to remember all these few points, and I think you need to memorize all these points. Fiscal policy, in the fiscal policy, if the emerging market has deficit to GDP ratio higher than 4%, then it's risky. Debt to GDP ratio, if it is 70% or 80%, then it's risky. Current deficit higher than 4% is risky. Foreign debt levels, foreign debt higher than 50% is risky. And debt levels higher than current account, 200% higher than current account, then it's risky. So if the debt levels higher than current account, but they are 200 times more than the current account, debt is more, then of course it's risky. And the foreign exchange reserve, if it is less than 100% of short-term debt, then it's risky. But if the foreign exchange reserve is 200%, if it's more 200% or higher, it is considered strong. So now we move towards forecasting equity returns. There are two approaches to this, and it's a calculation heavy segment. Okay, the first approach is discounted cash flow approach, and we have Grenold Kroner model. And the second approach is risk premium approach. Here we have single Terhar model. Level 2, we learn Gordon growth model as a discounted cash flow model to find out the equity return. Now, this Grenold Kroner model is actually the modification of Gordon growth model, and it has three terms: cash flow return, nominal earnings growth, and repricing return. Now, let's understand all these three terms a little bit more better. Cash flow return is nothing but the dividend yield, and share increases or decreases. So what happens that what the investor is going to get, investor will get the dividend yield, but the dividend yield will increase or decrease as the shares will increase or decrease. So if the shares increase, we will get less cash flow, and if the share company repurchases the share, that means the shares are decreasing, then the cash flow return will increase. So you need to remember this, when to use the plus or minus. If the company is issuing more shares, then you need to use the minus here. So dividend yield minus the share increase. And if the company is repurchasing the shares, that means we are adding the cash flow. So we need to use the dividend yield plus the changes in the shares. Okay, the second one is very easy. It is earning growth. So nominal earning growth, that means the earnings plus the inflation. And the third part is repricing return. That means the changes in the price to earning. So if there is a equity which was having valued as a PE ratio of 20, but if now after the changes in the valuation of that company, PE ratio is valued at the 30. That means there is a change from 20 to 30. So that is increase of 50%, almost 50% repricing return. So we need to remember all these three terms, and not only the three terms, but the names of the three terms. Now, in the next slide, let's take an example. So we have a Tempe International whose shares are selling at 250 rupees, and company has declared dividend of 5 rupees. Company is also going to issue 50,000 shares, and company already has 3 crore shares outstanding. Inflation rate is 6.5%, and price to earning ratio forecasted to increase by 0.5%. Nominal earning growth will be 7%. So let's calculate the expected returns using Grenold Kroner model for the Tempe. Okay, first we will calculate the dividend yield. Dividend yield here is 2%, and the share changes. Now the share company is declaring issuing the 50,000 shares. That means there is a change of 0.16%, and that is increase of the shares. So here we are going to have the cash flow return as 2% minus 0.6%. Why minus? Because company is issuing the shares. So we have the cash flow return of 1.84%. Now the second term, nominal earning growth, it is already given 7%, and it is nominal. So we don't need to add inflation to it. And the repricing return is 0.5%. So the total equity return forecasted for the Tempe International is 9.34% after adding all these three terms. Okay, second approach is risk premium approach in the equity return forecasting. And it is actually the capital asset pricing model. It starts with the risk-free rate. And then remember capital asset pricing model, CAPM model, we have done a lot of calculation in the second level. So CAPM model starts with the risk-free rate, and then you just apply risk premium of the market with the beta, and then you get the return. Now here, this is a lot of fun. The risk premium of asset is the most important, because in the equity return, what we are going to do is we are just going to have the risk-free rate as a starting point and then add a risk premium of the asset. So what is the risk premium of the asset? It is the beta. So the beta is actually the asset and market. The combination of that covariance and the variance. So covariance of the uh, our asset and the market, and then variance of the market. That is our beta. So we are not going to, I'm not going to go in detail into this. I'm just going to do the calculation for the RPA, risk premium of the asset. And the risk premium of the asset we calculate as a correlation of the market and the Sharpe ratio of the market and the standard deviation of the market. All these three terms you multiply. Now the next thing, we are going to do a lot of fun with this calculation in the next slide. First, just see how to calculate the RPA into two different markets. One is fully integrated, which is a developed market, and the second is fully segmented market, which is emerging market and not at all correlated with the global market. So to calculate the RPA for the fully integrated market, we need the correlation, Sharpe ratio, and the standard deviation. All these three terms, just multiply them. In the emerging market, RPA, because it is fully segmented market, that means it is not at all correlated with the global market. We just have the two terms, Sharpe ratio and the standard deviation. The correlation is completely omitted in the fully segmented market. Okay. Now the third case is where the market is neither fully integrated nor fully segmented. So we have in between. That means it is possible that maybe the market is 60% integrated and 40% segmented. We are not going to do the calculation of how to find out this integration or how to find out the correlation or the Sharpe ratio or standard deviation. Luckily, we will be given all these three terms in the exam, and we just need to find out the risk premium of the assets. So let's now take an example. Example of the Indian market and the Brazil market. Let's say both markets are neither fully integrated nor fully segmented. Okay. And I have given here Sharpe ratio, standard deviation, correlation with the global market, degree of integration, and the Sharpe ratio. See, this is all hypothetical data. Okay. It's not the real one. So let's calculate. I'm just going to calculate the Indian market RPA, and then you need to do the Brazil market RPA. Okay. So Indian market RPA, we will have to, how do we calculate when there it's neither fully integrated or fully segmented? In this case, what we need to do is, first of all, we need to calculate both these terms. We need to calculate the RPA for the fully segmented one. So in the fully segmented, we have what correlation with the global market, which is 0.75, and then Sharpe ratio of the global market. Remember, here it is not the Sharpe ratio of the market, but Sharpe ratio of the global market. So which is 0.13, 0.30. Okay, and then standard deviation of the market, Indian market. So that is 17%. So the whole, if we multiply the whole thing, then we get 3.825% as the RPA risk premium of this Indian market asset. Okay. Now let's calculate fully segmented one. For the fully segmented, we have Sharpe ratio and the standard deviation. That's it, just the two terms. So now we have the fully segmented RPA 5.1%. Okay. Now how do we calculate it when it is neither fully integrated or not integrated? Okay. So we will take the integration, degree of integration, and multiply it with the fully integrated. So we have here 3.825% as the risk premium. We multiplied it with the 80% of the degree of integration, and then remaining 20% we take it from the fully segmented market. Remember, because we have Indian market as only 80% is integrated, so that's why we are taking the risk premium, 80% risk premium
from the fully integrated RPA. Okay, so if we calculate this term, then we have 4.08% as the risk premium. Now remember, we need to add the risk-free rate also, and the risk-free rate here, let's suppose it is 5%. Then the Indian market return forecast would be 4.08% plus 5% risk-free rate, that is 9.08%. Okay, so now it is your turn. Calculate the Brazil market risk premium and tell me in the comment. And also remember the risk-free rate here, assume it's 6%. So calculate the market return forecast for the Brazil market. Okay, now let's look at the forecasting real estate return, our third asset. There are two approaches to it. One is again cash flow approach. The discounted cash flow approach is actually a capitalization rate, or we can call it cap rate. And then second is risk premium approach. So the capitalization rate is calculated by net operating income divided by property value. So it is kind of a dividend yield, and growth in this yield is our expected return on real estate. So what we can say is expected return for the real estate is cap rate plus net operating income growth rate. Now in the long term, net operating income growth rate is actually equal to the GDP growth rate, which we have learned how to calculate. And if it is a short term, then if we are calculating expected return on the real estate for the short term, then we need to use the other formula. Here we need to subtract the changes in the cap rate. So why do we subtract the cap rate growth for short term? Because as capitalization rate increases, value of the property decreases. That's why remember, if the cap rate is growing, then you need to subtract it from the expected return. And if the cap rate is decreasing, then you need to you need to use the positive sign, and you need to remember that the expected return on the real estate will increase if the cap rate growth is decreasing. For the real estate return forecasting is a risk premium approach, which is exactly same as the equity. In this one also, we are adding term premium, credit premium, and liquidity premium, all these premiums for the more risk on the real estate. Now the term premium will change from the equity premium. You know, for the equity, term premium is used for the inflation and supply and demand and all those other things. But here the term premium is for holding long term. So if you are holding real estate for the long term, then term premium will increase. The same way, credit premium, non-payment of rent. If we have in the real estate, the rent is not paying, then credit premium will increase. If the vacancy is more, the percentage of the vacancy for that real estate is more, then the credit premium will increase. And then liquidity premium is for the asset not sold quickly. So we can use a single Tehrar model with the two adjustment. The one adjustment is remove the smoothing effect and add liquidity premium to it. Smoothing effect, because as we said, appraisal, you know, the points are added because this real estate is illiquid and it's not sold very quickly, and so we don't have very lot of data points for it, and that's why we need to adjust it for smoothing effect. Question is it even possible? No, it is very difficult to predict exchange rates because there are many cogs, many moving parts, as exchange rate is affected by trading, financial systems, government regulations. So it is clear that we cannot calculate exchange rate, not even a probability. But what we can do is we can forecast direction, whether domestic currency will appreciate or depreciate compared to the foreign currency. So whether to invest in the foreign currency or domestic currency. So for that we have capital mobility formula, and it starts with the risk-free rate. So risk-free rate, but remember this risk-free rate is we are subtracting the domestic risk-free rate with the foreign risk-free rate. And the same thing is second term is term premium, credit premium, equity premium, and liquidity premium. But so we are just not considering these premiums alone. We are comparing it with the foreign currency. So if, say, for example, real risk-free rate is higher at domestic market, then the currency will depreciate. So it is better to invest in the local market. So the same thing with all these risk premiums. So if the term premium is higher at the domestic currency, then domestic currency will depreciate. If the equity premium is higher at the domestic currency, then the domestic currency will depreciate. You get the gist of it. For all these terms, if any of the terms, and then we just see, compare it, if the exchange rate will appreciate or depreciate. So remember that if the exchange rate is depreciating for the domestic currency, then invest it in the domestic market. This is the last section in the CME2, forecasting volatility. So far we have learned how to forecast return of various assets. Now, how about the risk or volatility of the assets? How do you forecast that? Now, this section contains many formulas, but it is not in LOS, so you won't be asked for the calculations. But there are few important things you need to learn and remember in this part. So forecasting volatility is done using four different ways. VCV metrics, that is variance covariance metrics, factor-based VCV metrics, shrinkage estimate, and smooth return to estimate volatility. Okay. The first one is variance covariance matrix. I have a complete detailed video of this in the asset allocation part. So in this one, I'm not going to talk much about it, but this VCV matrix needs few things. First of all, to get unbiased and consistent result, we need lot of data points. How many number of data points? 10 times number of assets. So for example, if we have 10 number of assets, and to forecast the volatility, we need at least 100 points. And also we need a sensitivity. We can say for now the sensitivity is like a covariance. So how many covariances we need? We need at least 450 in this one. So that is lot of estimates to be done. And because of this, we get biased and inconsistent result. To overcome this limitation of the VCV matrix, factor-based VCV matrix is used. Now, instead of using the number of assets, factors are used. So, n number of assets are there, k is the factor. Now, factors are less than the assets. And advantage of this model is we require very less number of sensitivities. So, again, only n multiplied by k. So for example, if I have 10 number of assets and I have 5 factors, then I'm going to use only 10 into 5, 50 sensitivities. Instead of 450 sensitivities in the VCV matrix, I'm going to need only 45 sensitivities. So that is the advantage of the factor-based VCV matrix. Now the third one is shrinkage estimate. Shrinkage estimate is nothing but averaging. So what we can do is we can predict the volatility using VCV metrics, and then we predict the volatility using factor-based VCV matrix, and we take average of two, or we can use a different weightage depending on the judgment. That's all in the shrinkage estimate. So to overcome the limitation of both the ways, VCV matrix and factor-based VCV matrix, we use shrinkage estimate. And the fourth one is the easiest way to forecast the volatility. Here we have used a lambda factor. So lambda is estimated. There are calculations. Again, those calculations are not part of the LOS. So we just use this as it is given. So what is the variance? We can say that if the factor is 0.6, then we have 1 plus 0.6 and 1 minus zero point 0.6, that 1.6 divided by zero point 0.4. This is the factor, this is the variance. So the actual variance is, say for example, 17%, then the variance will be 9 times the observed variance. So what happens that smooth data is for the illiquid assets. So in illiquid asset, we have observed relative volatility. This volatility is a smooth one, and we are not going to use this volatility as it is, because this volatility could be unbiased, or we can say it is underestimated. So because of that, we use the lambda factor. Now variance is nothing but the square of the standard deviation. So if the variance is 9 times, if we have used the lambda as a zero point 0.6 and then variance comes 9 times, then standard deviation is 3 times. This is very simple calculation, and only these are the few things you need to remember. So in the VCV matrix, remember that we need more data points and lot of sensitivities. To overcome this limitation, factor-based VCV is used. To overcome both these limitations of both the one, we use a shrinkage estimate. And for the liquid assets, we use a smooth return to estimate volatility. And that's all for this CME2.
So I have created a mind map, and you can download mind map PDF from the link given in the description.
I hope you liked this video. See you in the next video. Do comment, like, and subscribe.